All right. What's your next topic? Because I think this will be a fun one. Everyone loves talking Buffett. Everyone always has a hot take here. So you had a fun chart. Maybe I'll let you share it because I think it'll be fun for the audience here, if you want.
Sure. I did see some more comments in the chat. We'll get to that in a second. I gotta blow this up real quick. I'm starting to really think this just destroys our audio quality. Okay, so here's Buffett's purchases. This chart was brought up on Twitter, and it basically is all of Buffett's big purchases since 1988 and the pre-tax multiple that he paid to acquire these stakes or these companies. And so the big ones, there's Coca-Cola, Amex, Walmart, Wells Fargo, US Bank, Burlington Northern Santa Fe, so BNSF, Lubrizol, IBM, Precision Castparts, and Apple. And so the reason this got brought up, and the highest multiple paid on here was 14.6 times for Precision Castparts, but every other multiple was pretty much below 10 times pre-tax profits.
Below 12.
Or around.
Yeah.
Yeah. Yeah. He paid slightly more. He paid 10.1 times for Coca-Cola, 10.3 to 13 times for Walmart because he has to buy kind of over time. And then he paid anywhere from 9.3 to 14 times for Apple since 2016. So the point here is that a lot of investors say, or they quote the Munger, that Munger kind of changed Buffett's philosophy, that he changed it from buying okay companies at ridiculously cheap prices to buying great companies at fair prices. The thing is, these are not the fair prices that I think a lot of investors that follow that philosophy quote. These are still very cheap prices. These are 10% pre-tax earnings yields on high quality businesses. I think most people that quote that typically say like, yeah, I'm paying 35 times earnings, but like Buffett always says, better to pay a great price or a good price for a great company than
it's good context.
Price.
Yeah. I think this is his definition of a fair price, which is about 10 times earnings. I feel like that's just he likes to simplify things. He likes to, he doesn't say like, oh, I'm going to do some crazy DCF here, which he can probably do in his mind, but he likes to kind of hover around that 10 times earnings, I think, for his fair price. But his definition of a great price is probably like 3 to 4 times earnings, depending on the company, obviously. So yeah, I think that's a great example. What do you think was if you're
going to ask me what the best investment? Yeah.
Obviously, the numbers have played out so far, but I think, what do you think the one with the biggest margin of safety? And I'm going to go 7 times earnings American Express in the early 90s, because that was just really, really,
it's easy to say that now. I wonder what Amex was like at the time. I know when he first bought Amex in the fund, which was in like the 60s, people thought it was like the beginning of the demise of Amex. I don't know what it was like in 94, but it feels like we always look back and say like, wow, great company trading at 7 times earnings. Like there was probably something up with that. Some reason that it got there.
What about Burlington Northern at sub 10 times earnings, under earning too, because of the GFC?
Yeah, they've jacked up prices following that. Yeah. These are all good purchases. I don't know Burlington Northern that well. Honestly, I don't know a lot of these businesses that well. I still stand by I'm probably with you there that the Amex and the Coca-Cola purchases that were made kind of in the late 80s, early 90s were two of the most stellar ones, because it wasn't companies that were underfollowed or anything like that. These were the hiding in plain sight. People just got the narrative, or the narrative drove the price too low. And those are the ones that I really like, because it feels like those are probably the most replicable as individual investors to what he's done. I mean, it's hard to do, it's hard for people like us to do whatever convertible notes on Harley Davidson in 2008 or whatever we
True.
got.
True. Okay. I think anything else on that? I kind of think, yeah, it's just good context for anyone that says, oh, fair price, 25 times earnings. Typically, when he makes his big bets, he wants a high quality company at 10 times earnings. And I think that's just good. It's just good for everyone to think about.
What's your typical threshold? What's your version of a fair price?
It depends what business. It depends what business, because he goes for lower growth, right? Typically.
Yeah, that is the other thing is all these companies, well, maybe not, but
he just
they
doesn't
were
go
mature
for
businesses.
yeah, more mature, but can be growing. Yeah.
You're probably, I'm guessing most of the reports for these businesses, maybe there's some outliers here. We're forecasting probably mid-single digit top line growth for these businesses, probably at the time of the purchase, which I don't think people are considering that really high growth. But when you're paying 10 times earnings, it's kind of warrants the price.
Yeah. I think, well, for me, unless it's so I have a few different thresholds. For one, if it's a low grower that I think management's buying back stock or has good capital return strategy, right? I think an example for us that's resonant in our mind, and it's probably, I use this as an example a lot because it's been successful, with Sprouts Farmers Market, right around 10 times earnings, right? But if it's something that I think is a durable grower with a high competitive advantage, but maybe not crazy growth or a younger company, I'd say, and again, you have to make your own estimates, maybe 15 to 20 times earnings. And then for the maybe high quality company that I think has very strong growth prospects, might be a little bit riskier, blah, blah, blah. There's always so many unique things, and you have to sometimes estimate what the earnings could be because some of these companies aren't, earning to their full potential. I think something around 20 to 25 times is reasonable. But again, it depends. Okay, what do you think? It's going to grow 30% for 5 years, or do you think it's going to grow 20% in 5 years? That's or 4 or 5 years. I mean, that's a huge question. So I think I like to bucket into a few different camps, but typically, and I know Ryan likes to do this too, because we both do this, we look at, okay, what do we think they can earn? Maybe a little bit conservative because, things can go wrong. And okay, maybe 1-2 years out, can we buy this at 20 to 25 times the theoretical earnings if it's a high quality growth company? But for the more durable stuff, I think Amex is a good example here. It's kind of getting around where we think it would be a decent, opportunity. We want it more 13 to 15 times, something like that.
Yeah, I think I've gotten to the point now where if I have to forecast more than 20% top line growth to make the numbers work, I'm probably just not going to buy it.
Yeah.